Stop what you're doing. Right now in Dubai, you can walk into a gold souk shop and they'll sell you a 1 kilogram silver bar for the equivalent of $90 per ounce. Not $68, not $70, $90. That's a 32% premium over the COMEX spot price that every financial website in the world is telling you silver costs. And here's the part that should terrify anyone holding paper silver. That premium has been there for months. It's not a temporary spike. It's not a supply disruption from a storm or a strike. This is the market screaming that physical silver and paper silver are two completely different assets trading at completely different prices. In Singapore, premiums are running 25% over spot. In Shanghai, 18% to 22%. In Mumbai, 15% to 20%. Across Asia and the Middle East, the actual price you pay to walk out of a shop with physical silver in your hand is $80 to $90 per ounce, while COMEX futures contracts, the official price, trade at $68. This is the arbitrage that broke the system, and I'm going to show you exactly why it exists, why it's not closing, and what it means when the paper market finally admits that physical silver doesn't exist at anywhere near the prices they're quoting. Let me give you the framework for understanding what's actually happening, because this isn't just about premiums. This is about the complete decoupling of paper claims from physical reality. For decades, the silver market has operated on a fractional reserve system that makes fractional reserve banking look conservative. In banking, for every dollar in deposits, the bank might lend out $9, keeping a 10% reserve. It's leverage, but it's contained. In the silver market, the leverage is somewhere between 100 to 1 and 250 to 1. For every ounce of physical silver that actually exists in a vault available for delivery, there are 100 to 250 ounces worth of paper claims against it. Futures contracts, unallocated accounts, ETF shares that may or may not be backed, mining forward sales, bank certificates. This works perfectly as long as nobody asks for delivery. As long as everyone is content to trade the paper, roll their contracts forward, and treat silver as a number on a screen rather than a physical metal, the leverage is invisible. But when people start demanding physical delivery, when they want actual silver bars in their possession, the system breaks. And that breaking process is what you're watching in real time in Dubai, Singapore, Shanghai, and every other physical market on Earth. Here's how the fracture happened. In 2020, during the COVID lockdowns, something shifted in human psychology. People started questioning the stability of financial systems. They watched governments print trillions in currency. They watched supply chains collapse. They watched shortages develop in everything from toilet paper to semiconductors. And a subset of investors, particularly in Asia and the Middle East, decided they wanted physical assets, not financial promises. They wanted silver they could hold, so they started buying. The initial wave in 2020 to 2021 caused premiums to spike to 40% over spot. Mints couldn't keep up. Delivery time stretched to 6 months. But eventually supply chains normalized, new production came online, and premiums fell back to more normal levels of 5% to 8%. That was the warning shot everyone ignored, because the demand never actually went away, it just got more sophisticated. Instead of retail investors panic buying coins from local dealers, you had family offices in Singapore quietly accumulating 1,000-ounce bars. Sovereign wealth funds in the Gulf states adding silver to their portfolios alongside gold. Indian jewelers and industrial users hoarding inventory because they could see the supply situation deteriorating. And then came the industrial demand explosion. Solar panels require silver. Each gigawatt of solar capacity needs about 2 million ounces. In 2023 and 2024, global solar installations exceeded 500 gigawatts per year. That's 1 billion ounces of silver demand annually from one sector alone. Electric vehicles use silver in electrical components, about 1.5 ounces per vehicle. Global EV production is accelerating toward 25 million units annually. That's another 37 million ounces of demand. Samsung announced solid-state batteries using silver-carbon anodes. Production targets for 2027, 200 million units. Each battery requires 1.5 ounces of silver. That's 300 million ounces of new annual demand from a single product line. Add it all up, and industrial silver demand is consuming roughly 600 million ounces per year. Total global silver production from mining and recycling is approximately 1 billion ounces annually. That leaves 400 million ounces for investment demand, jewelry, coins, and all other uses. But here's the problem. Central banks have been buying silver, not at the scale of gold, but quietly, through proxies and in forms that don't show up in official statistics. Sovereign wealth funds are buying, and retail investment demand hasn't disappeared. It's gone underground into private vaults and allocated storage. When you add up all the demand vectors, there isn't enough physical silver being produced to satisfy everyone who wants it at the current price. The market is in deficit, and in a normal market, when you have a deficit, the price rises until demand decreases or supply increases. But that's not happening in silver. The COMEX price stays stubbornly range-bound between $65 and $72. Why? Because the paper market, where most price discovery happens, doesn't care about physical supply. It cares about sentiment, momentum, technical indicators, and most importantly, the ability of large banks to sell unlimited paper contracts to suppress rallies. So you end up with a completely irrational situation. Physical silver is scarce and getting scarcer, but the paper price suggests abundant supply. And the gap between those two realities is what you're seeing in Dubai. Now let me show you exactly how this arbitrage is supposed to work and why it's not working. In a functioning market, arbitrage closes price gaps automatically. If silver costs $68 in New York and $90 in Dubai, arbitrageurs should buy in New York, ship to Dubai, sell at $90, pocket the $22 profit minus shipping and insurance costs. That buying pressure in New York would push the price up, and the selling pressure in Dubai would push the price down until the prices converge. This is Economics 101. Price discrepancies create profit opportunities. Profit-seeking traders exploit those opportunities. The discrepancy disappears. Except it's not disappearing. The premium in Dubai has been above 20% for 6 months. In some cases, it's been above 30%. If arbitrage worked, that gap would close in days, maybe weeks, not months. So what's broken? 3 things. First, there isn't enough physical silver available to arbitrage. To close a 30% premium, you'd need to buy massive quantities of physical silver in New York or London and ship it to Dubai. But when you go to the wholesale market to actually buy that silver, not paper contracts, but real bars, you discover that available supply is tiny. COMEX registered inventory, the silver actually available for delivery, is currently around 47 million ounces. Sounds like a lot until you realize that's less than 2 months of global industrial demand. And most of that silver is already spoken for. It's not sitting idle waiting for arbitrageurs. It's in the process of being delivered to industrial users or long-term holders who stood for delivery. When you try to source 100,000 ounces of physical silver for an arbitrage trade, you find that wholesale dealers either don't have it or they're charging premiums that already reflect the Dubai price. The arbitrage disappears at the sourcing stage. Second, the logistics are expensive and slow. Silver is heavy and valuable, which makes it expensive to insure and ship internationally. A 1,000-ounce silver bar weighs about 68 pounds. To move 1 million ounces, enough to start closing the premium gap in a market like Dubai, you're talking about 68,000 pounds of metal. That requires specialized transport, heavy insurance, customs clearance, vault storage on both ends. The all-in cost to move silver from New York to Dubai can easily run 5% to 8% of the value when you factor in shipping, insurance, vault fees, and the time cost of capital. So a 30% premium needs to be more like 22% to 25% after cost to be profitable. It's still attractive, but the complexity limits how much capital can actually exploit the opportunity. Third, and this is the critical one, the people paying 30% premiums in Dubai aren't irrational. They're informed. They know the COMEX price is $68. They're choosing to pay $90 anyway. Why? Because they don't trust that they can actually get physical silver at $68. Let me explain what that means. In theory, anyone with a COMEX futures account can buy a silver contract, stand for delivery, and receive 5,000 ounces of physical silver at the contract price. But in practice, the COMEX is designed to discourage physical delivery. The process is bureaucratic. You need an approved vault, you pay storage fees. If you want to remove the silver from the COMEX system entirely, there are additional costs and paperwork. More importantly, there's a growing fear, justified or not, that if everyone tried to take delivery simultaneously, the COMEX wouldn't be able to deliver. The exchange would implement position limits, force cash settlement, or invoke force majeure clauses. This has happened before in other commodities. It could happen in silver. So the wealthy buyers in Dubai, Singapore, and Shanghai are paying 30% premiums not because they can't do math. They're paying because they want possession today, with zero counterparty risk, and they're willing to pay for the certainty that the silver is real, it's theirs, and it's in their vault. That premium is not inefficiency. It's the market pricing in systemic risk in the paper silver market. Now let me show you the specific mechanics of what's happening in different physical markets, because each region has its own dynamics that reveal different aspects of the breakdown. Dubai and the broader Middle East. The Gulf states have always had strong precious metals culture. Gold souks are institutions. But in the last 3 years, silver has become increasingly prominent. Shops that primarily sold gold now have significant silver inventory, and they're moving it at premiums that would have been unthinkable 5 years ago. Why? Because Gulf wealth, sovereign funds, family offices, high net worth individuals, has been diversifying out of Western financial assets since the Russia sanctions in 2022. They watched $300 billion of Russian reserves get frozen and realized their dollar and euro holdings could suffer the same fate if geopolitical winds shifted. Gold was the obvious first move, but gold is expensive per ounce and storage becomes an issue at scale. Silver offers similar inflation protection and monetary metal characteristics at a lower price point, allowing for larger physical accumulation without the same storage constraints relative to value. So you have Emirati and Saudi buyers accumulating silver by the ton, paying premiums because they want it now and they don't want exposure to Western exchanges or custodians. The premium is the cost of sovereignty. Singapore and Asian financial hubs. Singapore has become the precious metals trading center of Asia. It's politically neutral, has strong rule of law, excellent vault infrastructure, and a business-friendly tax regime. As a result, massive quantities of gold and silver flow through Singapore. But what dealers in Singapore report is that allocated storage, where specific bars are assigned to specific clients and segregated, has become incredibly tight. Clients are taking metal out of the banking system and into private vaults. They're not interested in unallocated accounts where they just have a claim on a pool of metal. They want their serial numbers. They want segregation. They want possession. This preference for allocated over unallocated, for possession over claims, is driving premiums because allocated metal is scarce. The banks and vault operators have plenty of unallocated metal on their books, numbers in a database, but actual, physical, segregated bars available for purchase? Far fewer. The 25% premium in Singapore reflects that scarcity of genuinely available physical metal outside the fractional reserve system. Shanghai and Chinese demand. China is the world's largest producer and consumer of silver. The Shanghai Gold Exchange trades physical silver with mandatory settlement. No paper games. You buy silver on the SGE, you get silver. For years, SGE prices tracked London and New York prices closely, with arbitrage keeping them aligned within a few percentage points. But starting in late 2023, the Shanghai premium began widening. By 2024, it was consistently 12% to 15%. By late 2025, premiums hit 18% to 22%. Why? Because China has been a net importer of silver for years despite being a major producer. Domestic production can't meet domestic demand from industrial users, especially solar panel manufacturers. And Chinese authorities have reportedly begun accumulating silver for strategic reserves, though this isn't officially confirmed. The Shanghai premium tells you that within China, Physical silver is scarce enough that buyers are willing to pay 20% over the international benchmark. And because China has capital controls, you can't easily arbitrage that premium. You can't freely move silver in and out of China to exploit the price difference. The SGE premium is the market's way of saying, inside China, there isn't enough silver, and the price to get more into the country is significantly higher than the global paper price suggests. India and cultural demand. India has deep cultural affinity for precious metals. Silver is used extensively in jewelry, religious items, and as savings. India is one of the largest importers of silver, bringing in 200 plus million ounces annually. Indian premiums have historically been driven by import duties and local taxes, typically adding 10% to 15% to the international price. But in late 2024 and 2025, premiums widened to 18% to 20%, even after accounting for duties. Why? Because Indian jewelers and industrial users learned from COVID-era supply disruptions that they can't rely on just-in-time inventory. They're front-loading purchases, building stockpiles. And the Indian investment community, which has traditionally favored gold, is increasingly diversifying into silver as gold prices have made large purchases prohibitive for middle-class savers. The combination of industrial hoarding and rising investment demand has created persistent tightness in the Indian market, and premiums reflect that reality. Now here's where this gets critical. Because the arbitrage isn't closing and the premiums aren't falling, we're approaching a bifurcation point where the paper market and physical market formally separate. Right now, the COMEX price is still considered the official benchmark. Financial media reports the COMEX price. Derivatives and mining contracts reference the COMEX price. But if you can't actually buy physical silver anywhere near that price, is it really the price? Imagine if stock market listings showed Apple at $180 per share, but you couldn't actually buy Apple stock for less than $240. At some point, everyone would acknowledge that the real price is $240 and the $180 quote is fiction. That's where we're headed with silver. The paper price will become increasingly irrelevant as the physical market sets its own clearing price based on actual supply and demand. When that happens, when the physical market openly trades at $90 or $100 per ounce, while COMEX shows $70, several things occur simultaneously. Mining companies will revolt. Miners sell their production based on COMEX prices or derivatives benchmarked to COMEX. But if physical silver trades at a massive premium, miners will refuse to sell at the paper price. They'll demand physical market prices or they'll withhold production. This has happened before in other commodities. It's happening right now in rare earths. Industrial users will panic. Companies that need silver for manufacturing, solar panel makers, electronics manufacturers, typically hedge their silver costs using futures contracts. But if those contracts settle in cash because there's no physical delivery available, and they still need to buy physical silver in the spot market at huge premiums, their hedges fail. Cost overruns, force price increases, or production cuts. ETFs will face redemption crises. Silver ETFs like SLV claim to hold physical silver backing each share. But if redemptions spike, if investors want to convert shares into physical metal, and the ETF can't source enough physical silver to meet redemptions, they'll have to suspend redemptions or go to cash settlement. Either way, confidence collapses. COMEX faces delivery default. If a significant number of futures contract holders simultaneously stand for delivery, demanding physical silver, and the exchange can't deliver from registered inventory, COMEX will be forced to either implement cash settlement at the paper price, screwing the longs who wanted physical, or force majeure, admitting the system is broken. The paper market loses legitimacy. Once it becomes widely known that the official price is 30% to 40% below the actual cost to acquire physical metal, the paper market becomes a joke. Traders stop referencing it. The pricing power shifts to physical exchanges like Shanghai or physical dealers in Dubai. We're not at that breaking point yet, but we're close. The 30% premium in Dubai is a warning light flashing red. The system is under stress. The fractional reserve game is being called. And the house doesn't have enough chips to cover all the bets. Now, let me show you why this arbitrage won't close. Why the premium will likely widen, not narrow. Global silver production is roughly flat. It hasn't increased meaningfully in years. Most silver is produced as a byproduct of copper, lead, and zinc mining. You can't just produce more silver by opening silver mines. It comes along with base metals, and base metal production is constrained by permitting, capital costs, and ore grade decline. Recycling provides about 180 million ounces annually, but that's also relatively fixed. Recycled silver comes from old electronics, jewelry, scrap. There's no hidden hoard of recyclable silver waiting to be unlocked. What gets recycled is getting recycled, so supply is capped at around 1 billion ounces per year, and demand is accelerating. Every percentage point increase in solar panel installations is millions more ounces of demand. Every million additional EVs is 1.5 million more ounces. Industrial demand is not price elastic in the short term. Solar manufacturers can't switch to a cheaper alternative. Silver's conductivity and efficiency are unmatched. They pay what they must. Investment demand is also growing. After watching gold go from $1,800 to $4,300, investors are looking at silver, historically gold's volatile little brother, and seeing massive upside. If gold can double, silver historically does 3 times or 4 times in the same period. Central banks, which have been gorging on gold, are starting to diversify into silver. It's not reported officially, but evidence is mounting that several Middle Eastern and Asian monetary authorities are accumulating silver as part of their de-dollarization strategy. All of this demand is crashing into fixed supply, and the result is that physical premiums will continue widening until demand is rationed by price. The paper market can't respond because it's not tied to physical fundamentals. The paper market responds to leverage, margin calls, and the ability of large traders to push prices around. As long as COMEX registered inventory doesn't literally hit zero, the paper market will continue pretending everything is fine. But the physical market, where real metal changes hands, already knows the truth. And that truth is that silver at $68 is a fantasy. The real price is $80 to $90 and possibly higher once the next wave of demand hits. Look, I'm not a financial advisor. I don't know your situation. I'm not telling you to buy silver. I'm showing you that the price quoted on financial websites is not the price you'll actually pay if you want to take possession of physical silver in most of the world. The arbitrage that's supposed to close the gap isn't working because there isn't enough physical silver available to arbitrage. The premiums in Dubai, Singapore, Shanghai, and Mumbai aren't temporary anomalies. They're the market pricing and the reality that paper silver and physical silver are no longer the same asset. When the paper market finally breaks, when COMEX faces delivery defaults, or when financial media starts reporting the physical price instead of the paper price, the repricing will be violent. Silver could gap from $70 to $100 in a single day because there's no inventory between those prices. The market has to jump to whatever level brings demand and supply into balance. And based on the premiums we're seeing in physical markets worldwide, that equilibrium price is somewhere north of $90 per ounce, possibly much higher. The arbitrage didn't break the system. The arbitrage revealed that the system was already broken, and Dubai is just the first place where the truth became too obvious to ignore.